All right, what is going on, Discord and YouTube family, and welcome back to another edition of Top Down Analysis with me, T. Hobbs. Today is 16 November 2025, year of our Lord, and of course, it is Sunday. As per usual, we're going to be breaking down the S&P 500, NASDAQ, and E-mini Dow futures. We're going to break down price from the 3-month all the way down to the 4-hour. Then I'm going to break down my levels, my weekly projections for the week. Last week, our weekly projections were spot on, but to the downside, right? We were looking at us being in super premium. We talked about, hey, I do anticipate us going higher, but I think that a pullback is imminent because we needed to come back and retest those 50% levels. We ended up dropping down a lot further, faster than I thought we would, but we got down there and we ended up hitting our weekly projections bearish. So going into this week, I think now that we're back in the discounted area, again, I'm looking at price to potentially continuously go higher. But we'll see exactly what happens. Let's break down those levels, starting with the S&P 500. Let's get right into the chart. So on the S&P 500, again, we're looking at the 3-month chart, right? I always like to start with higher time frame analysis because it gives you an idea of what price is doing in relationship to the uptrend and or downtrend that we're in. You can see based on the 3-month chart, we have 1 month and 16 days left. However, the monthly candle or the 3-month candle has already made a new high. Now we're coming back down to retest the close of the previous month's candle. 67.2125 will be an important level for price to continuously hold. If we're holding above the previous month's close, then that's an indication that buyers aren't willing to trade below that. And then the next best thing is we end up going higher. If we take our Fibonacci retracement from the lows of the previous 3-month candle, just to give an idea of where we are in price in regards to how deep we need to pull back to find new buyers. You can see right here, if I take this little Fibonacci retracement, right at the top, the 30% mark is 65.98. And then at 50% is 64.92. Characteristics of a strong uptrend is that we only pull back 50%. If we're pulling back less than that, then we're in a great uptrend. That's the way I'm viewing it. And as long as for the next month and 16 days, we don't pull back to 50%, I'm going to continue to look for longs to the upside, understanding that, yes, we are in premium. We could get nice, strong pullbacks, but the nod on the 3-month candle ultimately has to go to the bulls. Let's drop down to the monthly candle. And again, we bring back our Fibonacci retracement because, again, this is what's going to matter, right? Like, in order for the market to turn bearish, like, we're going to have to break some structure. It's not rocket science. It's just simple math, right? In order for us to turn bearish, the market needs to get below the previous month candle. With 12 days and 1 hour left in the month, we haven't been able to do that. Until the market trades below 65.40.25, I'm not even entertaining the idea that the market could be turning bearish. Is there opportunity when we're at premiums to go short? Absolutely. But ultimately, what is the overall trend? I gotta give the nod to the bulls on this trend. However, what we can say in regards to the bears is with 12 days and 1 hour left, the bears have not allowed the market to make a new high. I mean, granted, it is an all-time high, but at the same time, we have to be objective on both sides. Being objective on both sides is the reason why I'm more bullish on the monthly candle than bearish, because we tried to break through the open of the previous month. We tried to get down to the low end of the previous month. And you can see that the bulls are stepping in right at the very end at about 70% of the Fibonacci, which again doesn't indicate a strong uptrend. It indicates that the trend is becoming weaker because we have to dip down lower to find bulls, but it still means that the trend is still intact because the bulls are still defending and we got and traded above the opening of the previous month. So what am I looking for out of the monthly? Well, I have to give the nod to the bulls on the monthly candle, just because even though we're inside of the previous month, we're not breaking down below the previous month as of yet. Dropping down to the weekly time frame, again, this is where things start to get a little tricky, right? Is this a reversal sequence stepping up to the plate? We had a rejection block here or a rejection candle here. I don't want to say rejection block because I don't like using words that I don't truly know the definition of. This is what I do know. When we came up here, buyers failed at 69.55, and then they put in a new low below 68.43. When they came down here, they tried to make a new low below October 20th on the weekly, and they failed once. They came back down here and they failed again. To the other side, the bulls, although they did trade up here, they continuously fail at this level. If we take our Fibonacci retracement again, and we just fib out this candle here, you can see that just nice and clean, the bulls or the bears continuously get rejected right inside of the 50% of this wick here, which is a good sign. The only problem for all my bears out there is that the market is failing to close below any significant structure. That structure specifically, the change of character, is the candle, the weekly candle of October 6th. I think on the daily is going to be the October 10th candle. But that level, again, I'll reiterate, is 65.4175. Until the market can close below this low, I am not going to be convinced that this selling is strong enough to cause us to change character of the overall uptrend, right? There are some good things if you're a bear out there that I'm seeing on the smaller time frames, but from the 3-month to the weekly, I'm not seeing much that's convincing me to turn into a bear. Therefore, I'm looking for more upside going into next week, and I got to give the nod to the bulls on the weekly time frame. Dropping down to the daily time frame is where things start to get a little bit more interesting for the bears, right? The reason why I say that is because of this area right here, right? We're looking over here. We got a nice little double top, right? That's the first time we've seen, a clean double top followed by a break of structure, right? Bulls or bears broke this structural low here, right? They came down and broke this structural low here, or attempted to break this structural low here. The thing is when this low came back up, it failed to make a new high. Therefore, the market had to come back down and retest. Here's the problem if you're a bear, though. If we look at this the opposite way, we also have a double bottom, okay? And unlike the double top, when the bears came back down, or when the bulls went up, they broke this high. And then when the bears came back down, the bulls put it in a higher low. So the most probable thing that's next to happen is the market should be targeting here to go higher. Now, we could pull back into this wick as well before going higher, but that's something we'll see inside of the Tokyo Open, right? So ultimately, I'm still giving the nod to the bulls on the daily time frame, just because of the simple fact that they're still protecting that October 10th low, which is right here, right? This low is still acting as strong demand for buyers. So as long as that low is intact, I'm going to continue to be bullish on the market, right? If we get below October 10th lows, then my thesis will change. But again, looking at the higher time frames, I really don't see a reason for that thesis to adjust. Breaking down to the 4-hour time frame, what I want to do is I want to bring out the 200 EMA, because there's some things I want to talk about in relationship to the 200. You guys know anything about the 200 EMA? Essentially, it's one of the larger EMAs, or exponential moving averages, in the market or inside of trading systems that you use. It's very, very rare that the market gets below the 200 EMA. So it kind of acts as a long-term trend. The higher time frame you go, the more powerful it becomes. Therefore, if we look at the 4-hour trend on the 200 EMA, the last time the market was able to trade below it was back in February of 2025. That's when we got that aggressive push and rejection down to April of 2025. Okay. Other than that, every time we've broken below this on the 4-hour time frame, other than probably COVID, right, 2020, the market has been able to recover inside of strong downtrend, or strong uptrends. Well, this is a new test, because as of yesterday, or as of Friday, the market broke below the 200. But like I said, this level right here was also breaking below the 200, and it made a new high. Therefore, this is simply, in my opinion, a retest of this low, and we placed a higher low. And now I would be looking for the market to reclaim the 200 on the 4 hours, so above 67.80, give or take. And I'd be looking for more upside back to 68.97 and potentially all-time highs. And this week we have a major catalyst that I'll talk about later that can definitely push the market in that direction. Now we're on the 4 hour. Let's bring out our levels for the week, and I'll give you my projections on the week. Okay. All right, drop down to the 1 hour so we can see it a little bit clearer. Again, I've changed up the color scheme a little bit because, I don't like being the same. All right, so now what are we looking for? Well, we have a 1 hour resistance above us, right? Or what we call in the trader shop a ceiling, right? right? We have a macro high and a macro low. So we're inside of a range, inside of a range, inside of a range, which is basically how the market moves, right? Below us, we have a floor or a 1 hour support, AKA fair value gap area here, right? And then we are sitting inside of the PM session range as well. So if we want to be bullish on the week, then we want to see the market trade down first to go up. We're looking at plus or minus 2.71%. Well, where is that going to come from? The most probable area here is this 1 hour support zone. We come up from 6,700, basically, nice little psychological level, up to 2.71%, targeting 68.8175. If we get the gap up and we trade right above the previous day high, then I'm looking for price to push up from the previous day high at 67.9550, targeting 69.77.50 or 2.68%. Now, before you say, Hobbs, that's crazy, right? Like that's too high of a price. Remember, to the upside, we have a 3-month target on this instrument, right, of 9.68% or 7,173.25. So to me, this is just a pit stop along the path of that direction. To the downside, if I'm incorrect about the bullish behavior, I don't care. I'm looking to be on the right side of price. It's not about, hey, I'm right about being long and right about being short. No, I'm looking to be on the right side of price. Therefore, if we're going to be bearish, you want to see the market trade up to come down, right? And on the lower time frames, if you turn on the 200 EMA, on the lower time frames, such as the hourly, 2 hour and 3 hour, you can see that we're trading well below the 200 EMA, this little blue line here, which again is considered bearish, but we're in a bullish trend. So you'll get that, we'll get us trading below that 200 multiple times on the 1 hour. It's kind of like the 1 minute versus the hourly, right? So anyway, I digress. So what I'd be looking for is the 1 hour resistance here, the 1 hour resistance zone, market to trade up into 68.17, trade down 2.67% into 66.3425. If we can't make it up to the 1 hour resistance, then I want to see price start to reject the chessboard high, preferably the weekly fib at 67.8550, targeting 2.68% or 66.0425. Secondary scenario, if I'm completely wrong and the market just gaps down, which technically I wouldn't be wrong because I'm accounting for that, then I'm looking at 2.71% from the chessboard low at 67.0750, targeting 65.26, right? Or in breaking through officially that change of character at 65.41. So I'm on alert. I'm on high alert because every Friday for the last 2 Fridays, we've gotten the same thing. We've gotten a rally at the close, then a continuation on Tuesday, and then a straight dump session the rest of the week, right? And then they close it with another rally on Friday. Essentially, what they're doing is either the bulls are trying to step up or the market is trying to turn bearish and they're trapping bulls into the close so that they can put them in pain on Tuesday or Wednesday. So we'll find out exactly what it is, obviously. But those are my levels on the S&P 500. Let's move over to the NASDAQ. All right, moving over here to the NASDAQ, looking at the 3-month chart. Again, we can see the same scenario, right? We take our Fibonacci retracement. We go from the low to the high. We can see we've already broken above the high with 1 month and 16 days. And look at here at how clean the 30% retracement is, right? That's telling me that the bulls are definitely interested at these levels. And you were to just look at this Fibonacci retracement all the way through the monthly, the weekly, the daily, and the 4 hour, you would see that these levels are probably lining up with the exact same levels that I'm talking about on the lower time frames. In other words, the 3-month candle gets the nod from the bulls, okay? And again, looking at the monthly candle, we take that same thesis. We go to the Fibonacci retracement. We go from the bottom to the top of the previous candle, and you can see we're tapping right into the 70%, which indicates a deeper level retracement. But at the same time, deep retracements don't end trends, right? Change of characters in trends, right? Breaks of structure start the trend reversal, but the change in character has not occurred yet. And on the monthly time frame, that change of character is going to sit below that October candle, right? We need to close below that in order for the market to become bearish. If it doesn't, then I don't care. Like it's just, these are just pullbacks in my opinion, right? Therefore, the nod goes to the bulls on the monthly time frame. We come over here to the weekly, and this is where everybody's going to get the shakes, right? Everybody's going to start talking about their bears and the market's crashing and whatever. I mean, they said it here. They said it here. They said it here, everywhere the market pulled back. The next week you see YouTubers come out, and it's just, to me, it's lazy, in my opinion, right? Like it's lazy or ignorant. Either one is not good, in my opinion. Just because the market pulls back and then there's news doesn't mean the market is turning bearish. What you want to see is structurally the news and the fundamentals, right? And the technicals need to line up. And if you don't understand the technicals, you can't just go off the fundamentals. You can do whatever you want, but that's just my thought process. Anyway, the technicals tell me if October 6th weekly candle, if we can't close below that, and really it goes deeper than that. It's like September 2nd, right? If we can't close below any of these, we're going higher. Period, point blank. I don't care what anybody says, right? Until that happens, the market's going to go higher or consolidate. That's the only thing that matters, because let's just analyze what's happening. Bears step in at the top. They fail, or the bulls fail again to try to get above the top. So now we got to go find more buyers. Okay, so we come down here into this demand zone here, because this is a demand zone. 25,000 psychological level and demand zone. What was the result? Did we go straight through it? No. As soon as we came down here with all of this selling, the market came and pushed back up. More buying. Okay, cool. The next week, we went lower into the demand zone, checking out this neighborhood to see what's there. And did we go through it? No. Instead, we went even higher than the close, right, or the open of the previous week, right? 25.20, 220 was the open of the previous week. Well, we traded above that. So what does that tell you? The market's trading above the open of the previous week. The weekly fib is moving up. It dug down deeper, and the result has been more upside. So I'm going to continue to give the nod to the bulls until they show me something different. It's just that simple, in my opinion. Moving down to the daily time frame. Again, we analyze that same thesis. This daily or the weekly demand has to be 5, right? 5 daily candles. Well, 1, 2, 3, 4, 5 creates daily demand or weekly demand, right? And what are we doing? We tapped inside of that level, swept it, and now we're looking to go make a new high and then come back down and retest it. And the next time we retest this, it's going to be, if they can't break it, we're going to go take all-time highs, right? And like I said, there is a special catalyst this week that can very much do these things. Anyway, nod goes to the bulls on a daily candle just for the defense that I really like at the key level. All right, let's go down to the 4-hour time frame and let's bring out our levels for the week. I'll discuss exactly what I'm looking for on the weekly projections, and then we'll move on to the next instrument. Okay. All right, dropping down to the 4-hour, bringing out the 1-hour time frame here. Again, but above us, we have a ceiling. We're sitting inside, right? Let me zoom out and kind of give you an idea how I'm looking at this. So on the daily time frame, we created a macro range, right? In other words, macro range, sound like microwave. But anyway, a macro high and a macro low, right? So that's our range. That's our larger time frame range. So every time I come down to these lows, I'm looking for longs. Every time I come up to these highs, I'm cautiously looking for shorts because they're probably looking to break that. So we go down to the 4-hour and, closer to price, we have a ceiling at the 4-hour resistance zone. We have a floor at the 1-hour support. So we come down to the 1-hour, you can see that support is also a fair value gap at 24,758. So what am I looking for? In order for it to be a bull, I want to see the market trade down or gap up and go. Trade down to come back up. Okay, cool. Plus or minus 3.81% is what we're looking for. So we trade down back into that fair value gap or the 1-hour support zone right here at 24,760, I believe is what it says up there. Anyway, then we're trading up 3.81% into 25,707. If we gap up from the chessboard high, I'm looking at the previous day high of being my reference point. So 25,293 gap up, pushing into 3.73% or 26,239.50 back into the macro high. To the downside, again, I want to see the opposite take place. So I want to see the market trade up to come down or gap down and go, right? So there's 2 particular ways I want that to happen. 130 price is inside of these levels, and we're trading below 130 price to close the PM session, which is an indication that we're going to trade down to start the session on Sunday. So if that's the case, we still might pop up to come down. Weekly fib is right here. So I want to see the market test the weekly fib and come down 3.75% into 25,228. If we push right up, then I want to see the market tap that 4-hour resistance zone at 25,633.75 and then target 3.68% down to 24,692. Again, would be a higher low for the market, right? And then last but not least, if we gap straight down, I want to see us push right through the daily fib or the equilibrium at 24,959.75 and then push straight through this 4-hour or this 1-hour fair value gap, targeting 3.78% toward 24,959.75. And again, this would be the blow that would turn me bearish, right? As long as they hold this and then they pop back up and continuously fail, once we get if we get below 24,158 this week, Hobbs is going to be extremely bearish going into the next month. So we'll see exactly how they deliver it. But those are my levels for the NASDAQ, bullish and bearish. And again, ultimately, we're neutral. But again, there's a huge catalyst coming into the market this week that we usually sell off for. So none of this is a big surprise. And we'll talk about that here in a second. Moving on to the 3-month time frame on the Dow Jones. Again, I hate to beat a dead horse, but I mean, it is what it is, right? Like I'm just trying to give you the analysis from my thought process, right? You can see that the Dow Jones did trade back into the 50% at 45,260, but I don't think it's because it's weaker. I actually think because it's stronger, because the Dow Jones ended up trading much, much higher than NASDAQ and ES this week. It went to all-time highs. It aggressively pushed up and then it fell. But again, just to reiterate, the closing candle of the previous 3-month candle is not even being retested. We haven't even retested the previous 3-month candles. Just keep that in mind when you're thinking about or listening to people that want to say that the market is going dead, right? It's fine, right? They could be right. I'm not saying that I'm always right. I'm just saying, like, objectively, if they're not giving you the bird's eye view, you should look into your own chart and look at the bird's eye view, right? Look at it in depth. Now it goes to the bulls on the 3-month candle. Looking over here at the 1-month candle. Again, previous low, previous high, tapped into 50% and then found a new high. And it just doesn't scream bearish to me. It just doesn't. 12 days and 1 hour left, and we're inside of that candle with the high being led already for the month. If there's a new high and there's not a new low, and when we try to make a new low, we bought it up, it's usually a sign we're going higher. All right, so, take that with a grain of salt, or, Now we look at the weekly candle, which is going to turn everybody bearish, right? Because the market sold off. But what did it do before it sold off? It made a new high, not once, but twice, inside of 1 week. It made a new high, and yes, if this was a bearish reversal, or if we were in a bear market, I'd be like, oh yeah, baby, we're going down. But what did the market do at the low? Everybody's going to pay attention to this big wick. Okay, cool. That's great. I love the wick, and that is impressive for the sellers. But they did not finish the job. It's like that Kobe interview when they was interviewing before the finals. They was up 2-0. Reporter was like, you don't look happy. The job's not finished. If I'm a bear, I don't look happy because the job's not finished. They did not accomplish anything at the lows. The bulls got what they needed to get accomplished at the highs, but the bears are holding, or the bulls are absorbing bears down here at these lows, which is an indication that we could go higher. Am I worried about the rejection block? Not really. Why? I mean, the market's in an uptrend, right? As long as I'm following the trend until lows break, I don't care how this candle closes. As long as the market does not break through lows and does not close below October 6th weekly candle, you have to continue to give the nod to the bulls on the higher time frame. Moving down to the daily time frame, and again, this is where, the average person, or, most people are probably going to look at the market and say, hey, man, do you not see this big deadly candle right here? Of course I do. But they're ignoring the fact that we had 3 black crows coming up before that, right? So these 3 candles right here pushed up above these highs, and now we're coming back down to retest the point of origin. As long as the point of origin defends, which, judging by the wicks, I'd say that's a defense, right? As long as they continue to defend the point of origin, that means that they have intentions to go higher. Now the bears will get their chance when if price comes back to 48,000, then we'll talk from there. But for now, this is the range from this low to this high. And until that breaks, or until October 10th low gets taken out, I can't continue to be bearish on the market. Dropping down to the 4-hour time frame after giving the nod to the bulls again on the daily. Let's break out our weekly projections or our top-down analysis for the week, and then we'll kind of move on from there. All right, moving over to the 1 hour so we can kind of see what we got here. All right, we have the same thesis going on here. We have a macro high, we have a macro low, and then in between there we have our ranges. Now, unlike the other two instruments, there wasn't a really clean resistance. I mean, we do have this 1 hour fair value gap that I could have marked here. I just didn't. But we do have a ceiling, right? I'll mark it here for instructional purposes here, just so I know where it is. All right, cool. So just so we can have a reference point to kind of draw off of right later. But ultimately, the plus or minus on the Dow Jones is 2.59%, right? So if we're looking for the market to go higher, want to see the market gap up, trade down to go up, you know the deal, right? So if we're going to go down, we want to test this big green box right here, this big macro low down here, right? This is where we want to be, right? The market sweeps these equal lows, comes back into the macro low at 48,824, and then targets 2.59% at 48,037, okay? If we get the gap up, I mean, if we can't push down that low and we leave these equal lows, then I want to see the market basically bounce from where it is right now. Retest the chessboard low at 47,160, targeting 2.57% into 48,369. To the bearish side, we have to trade up to come down. Therefore, I'm looking for the market to push into the macro high and fail at 48,188. Right, we could get an aggressive push to open up the Tokyo session. That's literally what we've been getting every Friday into Monday. These last couple Fridays, we've been getting a rally, you know, into Monday, an all-day rally. Then Tuesday we consolidate, Wednesday we dump, Thursday we dump, right, and then Friday they buy it up. So I'm watching that, but again, the market is not breaking the low, right? That's why I put these levels on my chart, because if we're not breaking lows and when we come down here, I'm looking for buys, period. Right. So anyway, we're looking to target 48 or 46,981 to the downside, 2.51%. If we can't make it back up to the macro low, then we do have the weekly fib here, or that 1 hour fair value gap at 47,734. And I'll be looking for 2.54% down to 46,521 to the bearish direction. And again, breaking through the macro low, which then should take us to start targeting that October 10th low. There's other instrument in the market that have already taken that October 10th low. One right off the top of my head is RTY. So everybody has, or RTY has pretty much accomplished an objective for the market. We'll see what we do after completing that objective. So those are my levels for the E-mini Dow Jones. Let's go to some of the things that I'm picking this week to support my thesis, right? And when I say picking, if you've been watching the videos, you already know what I'm talking about. The volatility index, right? So the VIX, okay? We talked about the VIX from back here. We talked about once it got above this trend line, stand by, the market's gonna start coming down. Well, that's exactly what it did in October. And we put in a higher low, we got higher on the 17th. And ever since then, things have gone back to normal for the VIX, more and more failure. So what does that look like? Well, failure starts with a high, a low, right? And then lower highs. Well, that's what we're getting. We're getting lower highs on the VIX. So as long as that continues, I'm expecting the VIX to put in a lower low at some point. We have this gap from the contract change, right? Every month the VIX goes through a contract change. And every month it seems like the VIX gaps up and goes from the contract change just to fail and then close the gap. Once they close the gap this time, though, I think this will be the last time, in my opinion, right? I think this will be the drag. This is going to be, the next 2 months is going to be the push to all-time highs and mass euphoria. That is my thesis, and I'm using the VIX to support that thesis. And mass euphoria is going to bring us all the way back down to like historical lows on the VIX, and that's when I'm looking to be a bear. So that's my thesis overall. And again, I'm using the VIX to get me in that direction, right? So those are my levels on the VIX. Let's talk about news on the week. And then I want to bring you full circle to some of the things I'm watching on the week. So the news on the week, again, the government's open, right? But they're still suppressing the news for whatever reason. I mean, I'm not going to get political, but I have my reasons to believe why they're suppressing it. But a lot of FOMC speakers on Monday, so a big nothing burger, which if you already know, you know, if you know, you know, right? Mondays is clean because there's no news. But anyway, Tuesday, what are we looking for? Absolutely nothing. More nothing burgers on Tuesday. I'm gonna get into why this is like this because it's always like this, right? But Wednesday, 10-year bond auction for Germany. But then we got the FOMC minute meetings, which again is just going to tell us what we pretty much already know, what their thoughts were, all that type of stuff, right? And then on the 20th, this is what I'm looking forward to, right? We got non-farm employment change, aka NFP, and then we have unemployment claims. Unemployment claims still says tentative. I don't know why, but it still says tentative. So I don't know if they're going to release the results. They're not going to release this. I don't know. Last week, I covered all of the news that should have been put out this week. CPI, PPI. Once the government opened, it should have all been put out. And then Tuesday, they randomly took it all off the calendar and just never spoke about it again. So I don't know what type of market we're in. It's kind of weird, but it is what it is. So looking forward to the news. But if we don't get it, we've been flying blind for a month. So just trade instruction, right? Friday, again, flash manufacturing PMI. Finally, some red folder news to get this market really energized or give them reasons to hide their positions. Last but not least, the one thing that I wanted to cover, right, which I'll cover not extensively, but I'll break down my thesis on it real quick, is NVDA. NVDA, again, I've been charting this thing because it just goes hand in hand with the NASDAQ. And you can see it's in a macro high, a macro low, and there's been a lot of FUD, fear, uncertainty, and doubt that's been surrounding NVIDIA. Well, that's exactly what you need to get a better price, right? You start talking about the problems with China and the chips and blah, 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 right? That's what they do, right? It's fine. But let's look at the structure and see what the structure is telling us on NVIDIA, right? The reason why I'm talking about NVIDIA is because the earnings is in 3 days, right? You can see over here, let me pick the right thing here. You can see over here, NVIDIA's growth is driven by rising global demand AI through report limits to China after revenue. The Q3 could impact NVIDIA's stock price significantly. They report in 3 days. I don't really care what this says. The structure is telling me that the NVIDIA made all-time highs back on October 29th. After making all-time highs, the low on October 22nd that brought that all-time high, then turned around and made an internal range high, okay? An internal range high off these lows. So that's your dealing range, okay? From there, that internal range high ran through this liquidity and then got stopped at the inefficiency, which is what it should do. After being stopped at the inefficiency, it needs to go back and retest to make sure these bulls are for real. It needs to go back and retest the low. By placing a higher low is an indication that the market wants to trade higher. It takes out internal range liquidity here at 187. And now we should be balanced above 187 and looking to target higher prices. Liquidity first being targeted here at 203 and then potentially closing this gap at 206. And then the earnings come out in 2 days, which could take us way higher than any of these levels. So this is the reason why I'm remaining bullish on the market, because the market's going to go with the $5 trillion company. It's the largest company in the world via market cap. So the market's not going to dump until this thing starts dumping. So look outside the box or don't, right? I'm just giving you my thesis on how I view the market. That being said, ladies and gentlemen, that is all I have. I know this has been a little bit long-winded, but at the same time, it's a lot of information. I hope that this helps you along your journey. In the future, I will be taking a step back from YouTube, not for any other reason, just because I don't really think the channel is growing at a pace that I want it to grow right now. And I'm going to share all of my content via the Discord for now until I decide to come back. So I hope this helps you out. From this moment forward, there won't be any more top-down analysis from the Trader Shop that will appear on YouTube. I thank you guys so much for your time. And this is the Trader Shop. My name is T. Hobbs, and I'll catch you on the next one, man. Peace.